Good afternoon. My name is John Mountjoy, and I serve as CSG's Director of Policy and Research. I would like to take this opportunity to welcome each of you to CSG's Academy on Health Insurance Exchanges, What Can States Expect in 2018? CSG is the nation's only nonprofit, nonpartisan organization serving all three branches of state government. CSG's Academy series is designed to provide you with the information you need to make critical policy decisions. Today's program will cover the status of the individual health insurance market created by the Affordable Care Act. In November and December, open enrollment will be held for purchase of coverage for 2018. But much sooner than that, insurers must submit premium prices to state departments of insurance. We will hear about how the uncertainty of the Trump administration continuing subsidies to insurance companies to lower consumer out-of-pocket costs and whether Congress will approve a bill to repeal and replace the ACA affects the individual health insurance market. Before we begin, I want to highlight a few housekeeping items. First, this webinar is being recorded, and a link to the recording will be emailed to you once it is available on both CSG's website and our YouTube channel. Second, we welcome your questions during today's webinar. If at any time you have a question, please type it into the GoToWebinar dialog box that you'll see on your screen. And as time allows, we will attempt to have all questions answered by our speakers. We will also take all the questions after all the presentations have been made, so please hold your questions to the end. We'll begin our session today with the introduction of our first speaker, Emily Curran. Emily is a research fellow and faculty member with the Center for Health Insurance Reforms at Georgetown University in Washington, D.C. Her work focuses on private health insurance and the effects of the Affordable Care Act, with an emphasis on the implementation of federal and state health insurance exchanges. Emily, you have the floor. Welcome.
Great. Thank you, John, and good afternoon, everyone. Thank you for having me today. As John mentioned, I'm Emily Curran. I'm a research fellow at Georgetown, and we mainly study private insurance and health reform implementation over here. My particular focus is on the health insurance marketplaces, so I'm excited to be here today for this discussion, and I'd like to thank the Commonwealth Fund for their support in this research. So if we can move to the first slide, please. I want to begin the discussion by talking a little bit about a very brief refresher on why the ACA was enacted, and then move into where we are today and what we can expect in 2018. So to start, the ACA was really enacted to deal with issues of access, affordability, and adequacy. When it came to accessing coverage on the eve of passage, 48 million Americans were uninsured, and health insurers were allowed to engage in medical underwriting, which meant that they could evaluate your health status when you applied for coverage and determine whether to offer and deny coverage, at what price and at what exclusions and limitations. And since then, we've received numerous studies have come out saying that an estimated 1 in 5 individuals were actually denied coverage under this type of practice pre-ACA. So not only was it difficult to access care, but then moving into affordability, those that did, affordable coverage was difficult to obtain and purchase. So pre-ACA, the cost of receiving coverage caused as many as 73% of individual market shoppers to actually forgo care. And then, of course, because there was the risk that a carrier might not take you on later if a medical condition arose, people often felt locked into the coverage they had, even in the face of premium hikes on a year-to-year basis. And then finally, there was widespread variability regarding the adequacy of the plans that were being offered. So quite often, plans had large holes in the services they provided. For instance, many plans didn't cover maternity benefits or mental health, substance use disorder treatment, all those things that we're familiar with today as essential health benefits. So moving on to the next slide, what did the ACA actually do? Well, it started by enacting reforms in 2 major buckets. So first, there were early reforms in 2010, and then moving into 2014, there were more heavy-hitting reforms, we like to call them. And I won't go through all of these today, but as you can see, these reforms were really aimed at addressing those problems of access, affordability, and adequacy. So, for instance, some of the heavier-hitting reforms included prohibiting lifetime and annual dollar limits, allowing dependents to stay on coverage until 26, implementing a basic set of benefits that all qualified plans had to cover, like ambulatory emergency services, preventive care, labs, etc. And then, of course, prohibiting the denial of coverage based on a pre-existing condition. All of these really efforts oriented towards providing greater consumer protections on the market that didn't exist before. And then moving on to the next slide, in addition to the early market reforms, the ACA put in place, obviously, two of the other legs of the stool, people like to call them. So first, it put in place the requirement that everyone had to buy coverage or pay a penalty, with a few exceptions, of course. So this is known as the individual responsibility payment or the individual mandate. The penalty started at $95 or 1% of income in 2014, and since then it's grown to be $695 or 2.5% of income, the greater of whatever that is for the consumer. And if we take a step back at sort of the 300,000-foot level, the basic idea behind these three pillars was essentially that if insurers had to provide comprehensive coverage and they couldn't deny individuals, then there had to be a market of individuals to purchase that coverage. And if people were being required to purchase, then policymakers had to create avenues to make it affordable, which then leads into the last pillar, the financial assistance. And the law created two streams of assistance here. The first was known as the Advanced Premium Tax Credits, or commonly referred to as APTCs, and those are meant to provide assistance going towards your monthly premiums. So the eligibility and the amount of the credit is based on a sliding household income scale, and it's for those between 100 and 400% FPL. And then the cost-sharing reductions, the second form, are really meant to reduce your out-of-pocket exposures, so the cost of deductibles, co-pays, co-insurance. And those are available for individuals eligible up to 250% of FPL. So since there's been a lot of discussion, and particularly in the recent attempts to repeal and replace the law, I thought it might be helpful to sort of walk through a little bit how these two streams work, how they're accessed, and what the availability is. So if we can move on to the next slide, starting with APTCs. We often think of this in our world as akin to a gift card analogy, because once your APTC is calculated, you can then take and apply that amount to any plan of your choosing. So in order to be eligible, you can't have an offer of affordable, comprehensive coverage via another route. So you can't be eligible for affordable employer, Medicare, Medicaid, you can't be claimed as a dependent, etc. But once you're eligible, you can apply for coverage on the marketplace, and you can receive an estimate of this amount that you might get. And it's based on your estimated yearly income, your family size, and the cost of plans in your county. So in the right box here, I just want to walk through a really quick example of how this estimate is made. Not to get too in the weeds, but the tax credit is essentially based on the premium of the second lowest cost silver plan, the benchmark plan we call this. So it's based on that premium minus what your individual expected contribution is, or the share of your income that you're expected to put towards the cost of coverage. So for instance, a 40-year-old male making just under $29,000, that would put him at 250% of the federal poverty level. That means that he is expected to make an individual contribution of about 8.21%, or $2,300. So if the benchmark plan in his area is $3,200, the difference between that is his tax credit, the $882. So essentially, the tax credit makes up the difference between the actual cost and what an individual is expected to be able to afford and put towards the cost. So those who earn more are expected to have a larger earned contribution, and then vice versa, those who earn less have a lower contribution. And moving on to page 6, in this graph, you can really see why this becomes such an important and valuable form of assistance to consumers. So first off, in 2017, the selection period we just went through, 83% of consumers received APTCs to help keep their costs down, despite all the stories I'm sure we've all heard about increasing premium rates. So on the left side of the graph, the middle bar, you see the average monthly premium for a bronze plan in 2016 was $345. But after APTCs went into effect, the average cost to the consumer went down to $88 in premium. If you move over to the right side of the graph, look at the middle bar, 2017, the average monthly premium for a 2017 bronze plan went up to $439, but again, after APTCs, it was available to the consumer at $98 a month. So this graph I really enjoy because it helps to illustrate that, yes, premiums increased year over year. It's something that's likely to continue again this year and has historically happened pre-ACA as well. But with financial assistance, you often hear, particularly on the Hill, the stat that 77% of marketplace enrollees were able to find a plan last year for $100 or less a month, and this is why. This is the math behind it, because once APTCs go into effect, it helps to really lower that cost. So moving on to the next slide, the second form of assistance are cost-sharing reductions. And these I'm sure we'll talk a great deal about today. They've triggered an enormous amount of debate over the past year. So CSRs are available to those who fall in the income between 100 and 250 FPL. Unlike APTCs, which can be used across the meta-level tiers, CSRs can only be used on silver plans. Similar eligibility rules apply. Any individual who sort of applies and is assessed for APTCs is then also assessed for CSRs, or extra savings, we like to call it. And again, the amount is based on income and household size, so the lower your income is, the more CSR you have access to. And I think this is really helpful because if you qualify for CSRs, you also have lower out-of-pocket maximums. So the most an individual has to pay for in-network services before the insurer takes over the cost, that bar is capped at a lower amount. And you see that playing out in the last row of the table here. So an individual that falls between 250 and 400%, aka they are not CSR eligible, has an individual maximum of 7,100. So certainly useful that there's a cap on their individual max, but you can see that as the CSRs go into effect at lower income levels, that individual maximum drops to 5,700 and then 2,300. So you can actually see the effect of CSRs going into place and helping to keep those costs down. So moving into the next slide, what did the ACA achieve? So since 2010, the ACA has helped to expand coverage, make coverage more affordable, and reduce medical debt. So first off, the latest data we have from the CDC shows that the uninsured rate is at an all-time low. It dropped from 18% to 8.8% in just the last 3 years. 20 million more individuals have coverage. 12 million of those shop through the marketplace. Secondly, 83% of individuals are accessing APTCs and 58% of individuals are accessing CSRs. This is why discussion of the potential that these forms of assistance would go away is such a big deal because the majority of consumers rely on them. And then finally, we're seeing early evidence that the ACA has actually helped to reduce medical debt. So for years, the leading cause of filing for personal bankruptcy in the U.S. was due to medical bills. And since early reforms were enacted in 2010, personal filings have actually dropped 50%. So that's not to say that the 50% reduction is that every single filing is directly attributable to medical bills, but experts in that field have really reported to seeing the full share of families that report having issues paying medical bills. They say that the share reporting now has actually dramatically declined since the ACA has gone into effect. So finishing up here, moving on to the next slide. Of course, we're all here today because while there's been meaningful progress, the law is obviously not perfect, and there have been a couple bumps in the road that need addressing. I think if we look at enrollment, affordability, and perceived value and choice, these are 3 areas where perhaps some tweaks are needed. So kind of comparing the expectation to the reality of what came to pass. First off, we expected 21 to 23 million marketplace enrollees would be in place right now in 2017, and we only have 12 million. We also started off knowing that outreach and assistance funding was very critical for recruiting young, healthy individuals, making people aware of their coverage options, really expanding the pool of who participated. And the reality is that outreach and assistance funding has gradually increased. It's usually the first thing to go when states understandably have tight budgets. And then this past open enrollment season, we saw that the federal government cut $5 million in outreach and assistance funding in the final weeks of open enrollment, which is typically when the largest number of people attempt to enroll. In terms of affordability, despite the fact that APTCs and CSRs are something people really rely on, lack of affordability remains the #1 reason that people don't enroll. So while many can access the financial assistance, there's still a lot of concern out there that the amounts they receive are not sufficient, that the expected contribution is too high, that deductibles are too high, that the penalty for forgoing care is too weak to attract healthy young members into the pool. And then finally, I think this all plays into perceived value and choice. So we hear a lot that the increase in costs often put coverage out of reach for consumers, that people feel that they're paying too much in premiums to get nothing in return, particularly those in high deductible plans. And this really has the negative effect of pushing consumers to forgo care or drop coverage. And as I'm sure the panel will get into, for a number of reasons, this has led to insurers scaling back participation or exiting markets altogether and leaving consumers with fewer choice. So moving into 2018 on the next slide, to address some of these issues, in addition to the federal discussion going on right now, HHS released a final rule just a few months ago outlining some changes for the 2018 open enrollment period. I won't get into all of these. Some of them were highly technical in nature, but overall you should know that it was predominantly aimed at improving the risk pool and really attempting to provide greater stability to the market. Some of the more notable changes were reducing the open enrollment period from 3 months to 45 days, putting a greater emphasis on states to conduct network adequacy regulation, asking insurers to, and also I want to mention that they were also, a big part of this was tightening the conditions for when an individual is allowed to enroll outside the regular open enrollment period, so known as special enrollment periods. There was a lot of debate about whether consumers have been using these special enrollment periods inappropriately to enroll, only when they needed care rather than maintaining consistent coverage. And so a big part of this rule was really cracking down on tightening some of those eligibility avenues for consumers to enroll. And so I think notably one of the things that we're watching for here at Georgetown is that the rule left a lot of flexibility to state-based marketplaces, those marketplaces that operate and run their own systems. And so we think it'll be really interesting to see whether FBMs adopt some federal standards or if they go their own route. So for instance, California has already announced and committed to maintaining a 3-month open enrollment period, despite the fact that the federal healthcare.gov system will be shortening to 45 days. So I think over the summer, we're going to see a lot of variety coming out of the states as they figure out what they're going to take and leave. And then on the last slide, I just want to make sure to comment on the fact that while states are trying to work through how they're going to manage the open enrollment period, we already know that there are 2 big questions that are certain to impact the market. So the first being, is the individual mandate going to be enforced? And the second, of course, will CSRs be funded? So on day 1, there was an executive order instructing agencies to exercise all discretion and authority to waive or delay provisions of the ACA that might impose a burden on states. And many saw this as a direct threat to enforcement of the individual mandate. And insurers really responded to this. So for instance, if the mandate weren't enforced or was removed, Care First of Maryland commented that a lack of enforcement would be akin to completely repealing the law. And then in terms of CSR funding, I'm sure everyone's aware of the House v. Burwell case that's going on right now, and insurers have already made it abundantly clear that this type of uncertainty regarding whether funding will be paid out is largely going to dictate their marketplace participation and perhaps drive rates up. So I'll just leave you with this. Here are some additional resources in case you need additional background on this. But I think from my perspective, where we are now is marketplaces are deciding on their enrollment rules. DUIs are working with insurers to try and keep them in the market. Insurers are really struggling to figure out where it makes sense for them to participate and file. In a few months, we're going to see this all get tossed into the laps of consumers, and at that point, we'll have to figure out how much choice they have and at what cost. So thanks very much. I'll toss it back to the panel.
Very good. Thank you, Emily. Appreciate your expertise and insights. Our next panelist is Kim Holland. Kim serves as Vice President of State Affairs for the Blue Cross Blue Shield Association. She is responsible for ensuring that the 36-member Blue Cross Blue Shield company's interests are represented in the development of federal and state legislative and regulatory positions and priorities. Kim is a former career insurance producer and independent agency executive, and she served as Oklahoma's insurance commissioner between 2005 and 2011. Kim, welcome. You have the floor.
Thanks very much, John. And Emily teed up well kind of what brought us to where we are today, and I'm happy to offer you all the insurer perspective, specifically the blue perspective, but I think in many respects where industry is aligned in terms of our participation in the market going forward. So we can go to the first slide, John, and Emily actually explained this well, but I wanted to just offer a couple of other points relative to what the market as we entered into really 2016 prior to the elections. Indeed, we saw the lowest uninsured rate in history as a result of the efforts and the success that was made with the ACA. But indeed, we did see premiums increase dramatically. And although, as Emily pointed out, 83% of individuals were coverage was less costly to them personally because of APTC credits, there's that percentage of the individual market that received no credits and experienced those higher rate increases, which for many of them caused coverage to be unaffordable. It's also important to note that APTCs, or to remind you that APTCs are based on income, and so individuals that were making over 300% of the federal poverty level pay a higher share of their premium, and those increases did have an effect. Choice did go down. Some of the reasons for premium increases, or a big significant part of that, was indeed an unhealthy risk pool. That individuals, in terms of value, young people still found it difficult to purchase coverage. To some extent because of affordability, but in large measure just not appreciating the value or understanding the value of health insurance, and so the pool stayed more unhealthy. There was an anticipation of insurers getting into the market that there would be pent-up demand, and they anticipated that, but the risk pool remained unhealthy. It still is to this day in large measure because an older, sicker population dominating the risk pools. Deductibles went up to keep premiums down. 60, as Emily pointed out, about 58% of individuals that are on the marketplaces are eligible for those cost-sharing reductions. But for those that weren't, the average second lowest cost silver plan, from which the APTCs are based, the average family deductible in 2016 is roughly $700 or $7,500. So for a lot of people, that was very, very costly. Next slide, please. So going into the markets in 2016, what we saw is insurance carriers responding to the reality of the market, and certainly as we look forward into 2018, concerned about the stability of the market going forward. So what this map illustrates, as you can see, is the number of counties, or the number of insurers in counties across the country. The darker blue representing those with only one carrier, the lighter or medium-sized blue or middle blue representing two carriers, and the light blue, 3 or more carriers. Obviously, the red is 0. In 2017, about a third of the counties had only one insurer. For 2018, we've had several announcements of exits. We have 30 counties in Missouri that will have no carrier. If Medica, which is a small regional insurance carrier, exits, there will be no options in the exchanges in Iowa or Nebraska, and an additional 2 counties in Kansas. And just today, Anthem announced that they will be pulling out of Ohio, which will leave 20 counties bare of any exchange or any individual product available. So we certainly are seeing a reaction by the insurance industry as a result of the uncertainty created by today's political environment. Most insurance filings occur in June, so we will see by the end of the month we're likely to see, or throughout the month we're likely to see other, could be retractions, could be exits, certainly premium adjustments going forward. The next slide, John. I wanted to give you a snapshot of just this, looking at this in a different way, and what this illustrates is based on the type of exchange market that's in existence in the state. So you can see in those state-based marketplaces, as Emily mentioned, these states chose to develop their own exchanges and pretty much write their own rules within federal parameters, and that's where you do see the highest number of insurers participating in those marketplaces. On the bottom is the federally run marketplaces. That's the predominant number, and you can see that the participation is fairly evenly split between 1, 2, 3, or 4 in those marketplaces. This was actually prior to the information I gave you with respect to Anthem, as well as the retractions in Missouri, so it's not as timely as the map I just presented. In the middle, there were exchanges called partnerships. They agreed to take on responsibility for certain provisions of the marketplaces, but the back room, the actual operational functions, were retained by the federal government, and so you can see what happened with exchanges there. I know these slides will be made available to you, and so you can look at them more in depth at your leisure. Next slide, please. So as we move forward, and that is a backdrop to where we are with the House bill, the American Health Care Act, that was passed by the House at the end of March and now is being considered by the Senate, I thought it'd be helpful to give you just a couple of the highlights from our perspective of the issues that are likely that are being debated, certainly, and will have the greatest impact on consumers going forward. First of all, the individual and employer mandates are eliminated. They're replaced. The individual mandate is replaced with a continuous coverage requirement that I'll explain in a moment. Patient and state stability funds were dollars that are given to states in the form of grants to essentially reduce health insurance costs. It's intended to give the states the flexibility to design or impact their markets based on what they feel is most valuable to them to stabilize their market and help to reduce premiums. States under the AHCA, as the House passed it, are given a great deal of flexibility. It's yet to be known how the Senate is going to act on those. Market reforms were revised, changes to the ACA in terms of allowing a little more flexibility on actuarial value to allow insurance companies to develop lower cost plans that may be more attractive to younger and healthier people. The age bands that have been This is the factor that determines the extent, the breadth by which rates may differ between the youngest and the oldest eligible, and currently that's 3 to 1. So for if a young person's the youngest person's rate is $1, the oldest person's rate can't be more than $3. That would expand to 5 to 1. Again, targeting the younger people. It just means the younger people don't subsidize to such a great extent the cost of older individuals, and as we all know, our costs do go up as we get older and have more health situations. Continuous coverage requirements I mentioned. In this case, with under the AHCA, the continuous coverage requirement is a penalty essentially for individuals that do not enroll. There's a cost to that that would be imposed on top of the regular premium if they don't demonstrate a 1 year's continuous coverage. Tax credits, these are much different than the APTCs. Rather than, as you heard Emily say, the APTC credits are based not only on age, but they're also based on income oh shoot, I just forgot. The tax credits are based on 3 different factors, income and geography. And so what that allows is, first of all, the more you make, the less subsidy that you get. The less you make, the greater the subsidy. In terms of geography, there's a wide variety of premiums across the United States. As you well know, every state has its own healthcare environment, and premiums reflect that accordingly. Average premium in Alaska, for instance, an average silver premium might be somewhere around $1,000, where in New Hampshire it might be somewhere around $350. The tax, and that's accounted for under the APTC. The tax credits as proposed under the AHCA are a flat tax credit based on age only. So that same person, let's say you're a young person and you have a $2,000 annual tax credit. If you live in Alaska, that doesn't go nearly as far as if you live in New Hampshire. There are all of the taxes that are associated with the ACA were repealed. So you have things like the Cadillac tax, which has been much aligned by the business community, and that's the tax on what is referred to as high-cost plans. You have device taxes, you have the health insurance tax, you have a number of different taxes built in to help pay for the cost of law. Those were all repealed. There were several amendments. You may recall that the House bill failed the House failed to pass the bill or even to present the bill to the floor when they expected to. It was later they came back, and they did that after they had done some negotiation within the House. There are a few amendments that were added to the American Health Care Act, including $15 billion annually for reinsurance coverage or reinsurance, which would help lower the cost of premiums. The MacArthur Amendment that provides states with more flexibility in terms of waiving provisions of the essential health benefits and doing other things with continuous coverage requirements. And it also included, or the ACA also includes changes to Medicaid, which I'll touch on just briefly. Next slides, please. It's important to recognize that the House bill was passed without a CBO estimate. Normally, the House would present their bill to the CBO first and then pass it. It was not done this time, and so the CBO estimate wasn't released until May 24th. The big issue there is the Senate can't consider it until there is this estimate. What CBO has estimated based on the provisions of the AHCA that there, in terms of coverage, it would 14 million people would become uninsured, or more people would be uninsured in 2018 than in 2017, and by 2026 an additional 23 million more would be uninsured over what was projected, which would be 51 million in total, which effectively erases the numbers of people that gained insurance over the course of when we started this, because we started the discussions around the ACA with about 50 million uninsured, and so it would basically take us back to that point. They do anticipate reductions based on state waivers. State under the PASS funds, again, are given flexibility as well as under the MacArthur Amendment, and what they expect is that about 4% of the population will be in plans. But that those states that would keep their coverage similar to the ACA, you would see somewhere around 4% reduction in premium. Those that make moderate changes, for instance, they may change something with respect to the EHBs or otherwise, could see as much as 20%, depending on the types of changes that were made, a 20% reduction in premium. But they also estimate that some states could take really dramatic actions, and they could not even estimate what that might be or what kind of impact it might have on premiums, in large measure because some of those changes could actually make the value of coverage make coverage not as valuable to people, and you would actually see, depending on what they do, either individuals with health conditions not being able to get coverage, or it being so costly they would drop coverage, which would change the risk pool even further. So they were just not even able to estimate in that. In terms of the budget impact, the estimate is a $119 billion reduction in the federal deficit, which was the budget charge for the House to reduce the deficit. $834 billion of that comes from Medicaid, and another $276 billion from the tax credits. Then you have to add back in the dollars that are expended in the PASS funds, which is $210 billion, and the $664 billion that will not be received as a result of the taxes being repealed. So that's how you get to that $119 billion, and that's the number that the Senate has to work from. They have to essentially match that number. Next slide, please. So as I mentioned, I just, in terms of the key issues being debated in the Senate, the tax credits, as I described them, given the fact that they are age-based only and the geographic differences, there's concerns expressed by many of the senators that is challenging. It also puts some of the older people could be most greatly impacted by the change in those tax credits, and there's concerns about that. The market reforms, the concerns of how much state flexibility is given, even though there is, I think, an interest in many of the states, certainly among governors and in Congress in general, of allowing states to have more flexibility. The breadth of that could be concerning if you have states that that were to repeal areas of the EHB, to impose something akin to medical underwriting again, or allow pricing based on health conditions, that those could create some real concern. So there's issues around that. I can tell you that governors particularly, and perhaps you all and members, legislative members, as well as other policymakers in states, are very concerned about some of the Medicaid provisions. We'll talk a little bit about those, but those you have the issue of expansion versus non-expansion state and the equity of funding. Those that didn't expand feeling strongly that there should be an equitable amount of dollars coming into their state, allowing them more flexibility to direct those to Medicaid beneficiaries. They're also concerned about the projected growth rate that's being proposed. Medicaid Medicaid program medical cost growth rates tends to run higher than other medical growth rates, and so this is pegged at CPI plus 1%, which states are concerned is inadequate and will not be sustainable over time. So that's another big issue. Just in general, as the Senate continues their debate, as you know, that this is being considered under a reconciliation, which is important to the Senate because it means that if they can reach agreement on a bill, they can pass it with only a simple majority, which only requires them to have 50 votes because Vice President Pence could be the 51st vote in the event that they don't get the full Republicans in this case, which is what is expected would happen, to vote on the bill. So, but in order to achieve that, there are some very stringent rules on the nature of the bill, what it looks like, what it contains, how it marries up with what the House passed, and that is up to the Senate parliamentarian to basically scrub the bill and determine whether it meets all the provisions, what provisions have to be kicked out, which can be kept in, and what kind of impact that has on the score. And so that will be another part of the process. And then after all that's said and done, assuming that the Senate can get a bill passed, it has to go back to the House. And this isn't the only thing they're dealing with. As you well know, tax reform has been the White House's big issue, and they really want to move this forward as quickly as possible so they can move on to tax reform and other issues. So we'll see what happens. Next slide, please. Next slide. Yes. Thank you. In terms of the cost sharing reductions, this is probably, as Emily pointed out, one of the most critical issues with respect to the industry. The reason why it's such a big deal is those cost sharing reductions were baked into the premiums, into the cost of plans when they filed rates in prior years. And so what happens in this is that we're obligated first and foremost to provide the benefits, regardless of whether we are reimbursed for the cost sharing reductions, and that was priced into the plans with the understanding that the cost sharing reductions would be returned to plans. So in the event that does not happen, it means for 2017, it means that it could result in further losses. 2018 going forward, it means that premiums have got to be adjusted, and the estimates are that it could be as much, it ranged from 12 to 19% increase in premium as a result of cost sharing reductions by itself. So there was a lawsuit filed by the House in 2016, and the White House asked the court to place the case in abeyance because of the new administration, and saying we don't know what we're going to end up with. They agreed that they would revisit it every 90 days, and most recently the White House asked the courts to continue abeyance for the next 90 days. So this has only to do with 2017 payments. There's still no reassurances that the cost sharing reductions will be funded in the subsequent years, and again, that's creating a great deal of uncertainty in the marketplace and affecting premiums that are being filed today. Next slide, please. Just briefly on Medicaid, because I'm sure it's something that you're all interested in. Again, most of the savings out of the House bill come from savings to Medicaid. It would first and foremost scale back expansion over the next few years, basically sunsetting it, and per capita caps appear to be gaining support over block grants for the purposes of the federal government capping the amount of dollars that they're going to return to states to help support their Medicaid programs. The president's budget actually calls for further cuts. So when we look at it, if you consider what's in the AHCA if it were passed as is, along with the president's budget, it would be $1.3 trillion in reductions to states for Medicaid, which essentially cuts the Medicaid program in half, or at least cuts spending in half. Senate is very concerned about Medicaid program. There's a lot of internal debate about that, but and mostly centered on the concern of loss of coverage to a very vulnerable population. They're somewhat skeptical that the target savings can be achieved overall. But the fact of the matter is, again, they have to produce savings equal to what the House did. So there's some real issues here relative to how the pool of money available is split between the commercial markets, the Medicaid programs, in a way that creates a stable market. One does have an effect on the other. If you see for states, as you would well know, most states, if there's a reduction in cost to Medicaid, there are options in terms of addressing those reductions is either one of three, perhaps. It's to reduce eligibility, it is reduce reimbursements to providers, or it's to raise taxes, none of which are very appealing. And they have consequences elsewhere. If you reduce provider reimbursement rates, providers need to make up the difference. They make up the difference in the commercial market, and that cost shift just increases cost of coverage there. So a lot of very big issues here. There's a shared goal, though, of providing states more flexibility in their Medicaid benefit designs and cost sharing, and certainly streamlining the process for Medicaid waivers, allowing states to be more innovative in programs and promote managed care. Next slide, please. I'm not going to go over this slide in the interest of time, but it speaks to some of the other issues and provisions that are in the bill relative to Medicaid. Just encourage you to take a look at that, and you're welcome to contact me if you have any questions. But I did want to give you a sense of what we're looking at going forward. And this is just kind of a little bit of a timeline to let you a snapshot, if you will, of what the key issues are and key timelines are right at this point. So as I mentioned to you, rates are filed between June and July. That's a little later than it was in prior years, and most of the rate filings will occur in June. So we'll have a better indication of market penetration, market participation, and what the costs are going to be. I mentioned to you the Senate's, I mentioned to you the Senate has to vote. There was an expectation the Senate would come out with a first draft of their proposal to circulate among their members this week. It looks like they may make that deadline. They've talked about a vote prior to recess in July. Forgive the tongue-in-cheek squiggly line. It seems like every day we hear a different date, a different tone, a different tune in terms of whether they're actually going to be able to accomplish and meet those deadlines. Obviously, again, there are a lot of other things on their plates, a lot of issues that are being discussed that have nothing to do with healthcare. As important as this is, there still is not consensus, or it's difficult to reach consensus within their body as itself. We did hear today that it looks like it seems to be they seem to be coalescing around a program, so it seems more possible today that they could have a vote before recess, but it's still uncertain. Rates are due to HSH by plans in the middle of August, and so that's kind of a lockdown date, mid-August, so you can appreciate that's for 2018, why this is all important. There's discussions about the debt ceiling and what kind of impact that will have on any decisions that are made, and then you have September 30th being the fiscal year end, and at that time plans have to sign their agreements to continue or to actually move forward with 2018 enrollment. So even if they file rates, they've got until the end of September to make up their mind. And if we don't see certainty in some area of the opportunities here, whether it's in the Senate's draft, you know, a smaller package that might get pushed through with the debt ceiling or some other mechanism to provide assurances in the market, you could see more retractions. So let me stop there. John?
Very good, Kim. Thank you so much for that. Our final speaker is Kentucky State Representative Steve Riggs. Representative Riggs represents Kentucky's 31st House District in Louisville and has been a House member since 1991. That's 26 years of service. He is an independent insurance broker and consultant and longtime member of the Banking and Insurance Committee in Kentucky. He is the current president of the National Conference of Insurance Legislators, or NCOIL. NCOIL works to assert the prerogative of legislators in making state policy when it comes to insurance and to educate state legislators on current and perennial insurance issues. Representative Riggs, you've heard the first two presenters describe the uncertainty of the current individual insurance marketplace. Can you help us understand the policy questions facing state policymakers, both now and into the future?
Yes, I can help you understand it. Go back to that slide with the squiggly lines and follow those lines. It's a lot of back and forth, isn't it? Can you hear me?
Yes, sir.
I want the folks that are listening that are not elected, I want them to not be too distraught over the squiggly lines and the amount of back and forth. That's the nature of the democracy that we have, is that we argue a little bit and everybody's viewpoints are heard for the most part, and there's a lot of back and forth and squiggly line as we get to the end here. So I thought those two presentations were just awesome. I wish I could pass a law that required every member of Congress to sit through that. I don't know if we could get 45 minutes of their time to do that, but that's very informative. So for the commissioner and Mrs. Curran, you know, my hat's off to you for that summary. Now, some of the things that I think we have to go back and look at what do we want to accomplish with this? What is this whole complicated process supposed to be about? I think it was intended to reduce the number of uninsured Americans. I think that was the intention. So from that perspective, it's very successful in the sense that we're now down to 9%. But perhaps the way we went about it was too costly, or it didn't spread the cost in the right way. So that's what we're debating about a lot now. So I know that a lot of the savings in this latest proposal by the Republicans that are in charge of Congress, the latest proposal, and matter of disclosure, I'm a Democrat in a southern state. So, you know, one of the things that I'm not sure when they look at it, if they're thinking a lot about what I've heard, and that is, let's just let it die on the vine. The more we can throw up roadblocks and kill it without looking to appear to kill it, then we'll be better off. Some of the more moderate Republicans that I've talked to say, no, that's not the case. We don't want to see that happen because there have been some positive improvements and changes. We just have to keep working on making it better. Now, some of the things that I think are interesting to note as we talk about this are the big savings in this plan. The bulk of the savings is in the Medicaid reduction, the Medicaid changes. I think the proposed cut, I wish we could go back to the slides, but it was about 25% of the total savings. And so how does that square against President Trump's commitments when he was campaigning that he didn't want to commit Medicaid? Does that mean he's going to veto it because this clearly cuts Medicaid? It's a big part of it. Or does that mean he's changed his mind? I don't know. We have to ask him that. But it's an important question. The other thing about the presentation I think we have to learn is that the people who work in it every day, the insurance agents and insurance company people, tell me they thought the penalty was too low, the initial penalty. So many people didn't sign up, especially young people. And if the penalty is too low, or if you take away the individual mandate, that's probably another way to make it just die on the vine, because I think it falls apart, in my opinion, if there's no individual coverage that's required to participate in the system. We all know that insurance works best with the law of large numbers. And when you start cherry picking, when you start pulling out different people for different reasons, then you end up messing up the law of large numbers. I was in a debate on TV a month ago, and the ultra-conservative member of the panel was really upset about individuals have to pay premium, even though some of them can't get pregnant. He was talking about men, of course. And he said, this is really unfair to me. You want to make me pay premiums into a situation in which we're providing maternity coverage, and I could never use maternity coverage. Well, we know, to me, that's just so false. Because the women could have come back and said to him, well, you know what? I don't want to pay because I can't get prostate cancer. So then everything falls apart. So, first of all, you got to try to get the political shenanigans out of the way first, to try to get to some more solutions that work, and quit throwing up things we know that are designed to mess up the entire pool. Another comment I would make would be that it's interesting that the state-based plans seem to have the most insurer choice, or its insurer choice is highest in the state-based marketplaces. But in Kentucky, we had one of the biggest success stories of all time, and we participated in the ACA, with our own exchange, and it turned out to be great the way we handled it. Now that's been rolled back quite a bit, but another thing that I noticed that I thought was interesting was that when you gave the map, Commissioner Holland, when you gave the map of the states and showed all the different states and the shadows of how many carriers they were, I thought it was interesting that it didn't fulfill the expectations. For example, I saw Arkansas and New Mexico with 3 or more carriers, in Montana, a rural, sparsely populated state, and I thought that was interesting. But then you go to Kentucky has largely, or at least more rural, like Arkansas, New Mexico, and we have a problem keeping more than one carrier. Half the state only has one carrier. And then I go to Utah, which is considered to be one of the healthiest states in the nation, and half of their state only had one carrier. So I'd love to ask your opinion when you open this up, Mr. Moderator. Maybe we can get her opinion on those kind of anomalies. What do you all see in things of that nature? Because I thought Utah, everybody would want to write insurance there, and they don't. So those are some of the things that I wanted to point out. I know that the cost sharing reduction is a #1 priority for those that care about this system, and that if you take away that or make it very unpredictable, then that's another way to just try to kill the whole ACA, or without saying that you killed it, because those are critical. Sometimes people don't understand, even liberals don't understand, that the insurance companies aren't writing this coverage as a matter of charity. They are for-profit companies, and so for the most part they are, and they have to write it and make a profit from it. One of the things that I liked about the ACA was that it required insurance companies to spend 80% of the revenue on claims. And I don't know why the conservatives want to get rid of that rule. I think that's very important, that they take their revenue and spend it in the right places, and it gets rid of the, anecdotal trips of, or stories about too many trips to Bermuda and CEOs getting paid way too much, just on and on and on about improper spending by large insurers. So those are just some of the...
Why don't we move into some questions if we can?
Go ahead.
And one of the questions that we would put out there is, Kim, if you could take this one for us, sort of one solution we hear a lot about is allowing health insurance to be sold across state lines. Can you maybe share a little bit of insight into what are some of the pros and cons of that approach?
Well, first of all, insurers can sell across state lines. If you look at a Cigna or national carrier, they're able to sell in pretty much any state that they're licensed in, right? And that's really the only barrier. The barrier is in terms of selling coverage in a state is being licensed in that state. State insurance departments have certain requirements in terms of how they do business, their capital and so forth, to protect consumers, make sure they've got to actually have enough money to pay claims. But the real cost to an insurance company is developing a network there. And so where let's say I'm a regional company, or I'm a company in Texas, and I don't currently write business in Oklahoma. For me to go into Oklahoma, I've got to create a network of providers to do business with me, and that's where the real expense is. So unless I have that, the product that I might offer in Oklahoma is not going to be attractive to people, because those contracts with providers stipulate and agree means that we agree on the price I'm going to pay you. Otherwise, a provider can just charge whatever they want. So the real issue here is networks. It's not the opportunity to do business elsewhere, because you can write in any state that you want to as long as you're licensed there. It's the investment, the capital investment to build the infrastructure to actually offer a competitive product. So a bill that says, Georgia, for instance, has a cross-state lines bill that they passed a couple of years ago. There are 2 or 3 other states. I think Maine is another state that has one. But that hasn't increased the number of carriers doing business in those states, because, again, the issue is not a regulatory barrier or a legislative barrier. It is an infrastructure and capital barrier, that unless they feel that they can cover their losses, they're not going to go and do business there.
I just think that's more of a campaign slogan that offers false hope to people, because which state's rules are you going to use? My state, Kentucky, we have mandates, like we require coverage for mammograms. Other states don't. My state, both Republicans and Democrats, decided that we ought to have colon cancer screening, because we're going to do for cost in the long run. Another state like Utah might only have 10 mandates like that, where we might have 50. So, okay, which state do you want to use? It just seems like a campaign slogan to me.
Well, if I can follow up on that just briefly, Representative Riggs, you make a really good point, because usually the conversations around cross-state lines is the mandates conversation, because some states have more required coverages by law than other states, but really mandates typically follow constituent demands, right? And they also frequently put into law what insurers are already doing. So, the suggestion, if I'm in Kentucky, and as you point out, your legislature agrees and you pass a law, which is no small feat, to require insurers to do a certain thing, and your governor signs it, right? Why should that process, somebody be able to bypass that process as a resident of your state and say, I don't like my laws here, I'm going to go someplace else? So there is that, just the legislative, the legislative issue around that too, right?
Emily, this question's coming to you. When exactly will consumers know what plans at what price will be available in 2018? And what would you advise consumers to look for when they decide what plan to purchase?
I think the name of the game, once again, this year is going to be shop around. So already, I think Kim commented on this, we have received public rate filings from about 7 states so far, and the requests for increases range in the teens to the high 30% in terms of increasing premiums year over year. So I think that a lot of insurers have rightly noted that CSRs are a big deal, and they might go back and make some additional tweaks. So I think that as we see these numbers start to trickle out, we'll have a better feel for what the actual costs are coming towards the end of the summer, and then of course when plans go live towards the end of October, early November, when November 1 open enrollment begins. And as always, we always push significantly for consumers to go back, check their eligibility for CSRs, check their eligibility for tax credits, and shop around and see what costs you can get, because if those streams of financial assistance remain in place, hopefully, even if choice goes down, even if premiums go up, hopefully consumers will still have access to some plans that they can afford.
All right, very good. Let me ask one last question. Kim, the individual mandate is a hot political issue as Congress looks to repeal and replace the ACA. Can you help us understand why insurers believe that the mandate is a way to keep premium prices down?
I think continuous coverage is really the most critical thing. The concern, and to some extent, this is some of the concerns that evolved over time with the ACA. If the whole notion of insurance is spreading the risk over a large number of people. You have the healthy people offsetting the costs of the sick people, and recognizing we all can start off healthy and ultimately are going to have a health condition. It's important that people contribute to that cost over a long period of time. It's kind of like you're mortgaging your healthcare costs. When you have an environment that allows people to purchase and obtain coverage without any pre-existing conditions only when they get sick and drop off when they get well, you obviously are not able to sustain that. There's not enough money coming into the pool. People that are sick are always motivated to have coverage. They're going to be motivated because they need care. But you have to create that incentive, and sometimes that incentive is a stick. You can try it with a carrot, but oftentimes that's not enough. The ACA did both. The ACA provided a carrot by providing subsidies for many people so they could actually afford coverage. But it also created that stick that says if you don't do this, there's going to be a penalty. And that's to ensure the health of the risk pool. Over time, what we saw is somewhat of an erosion in the ability for people to actually get on coverage under special enrollment provisions that were quite liberal and allowed people to kind of jump on a plan at the point of they needed care, and other things that kind of eroded those principles in an interest to encourage enrollment. But over time, you have to have that balance of healthy and sick, and the only way to get that is to provide those carrots and sticks. So if Congress takes away that mandate, there will be a number of people, and mostly, people are going to work, always act in their own self-interest, understandably. And if you're young and don't think you're ever going to get sick, you're not going to participate in a plan. You're not going to spend whatever disposable income you have on insurance. That's not going to be your first priority. And that just means the risk pool is only unhealthy people and the costs aren't sustainable.
Thank you. Well, we've reached the end of our time. I'd like to thank all of today's presenters for their participation in this webinar, and I'd like to thank each of you for joining us. As mentioned during the introduction, this webinar will be archived on the CSG website and available for future use or reference, and a link will be provided to each attendee. CSG's next eAcademy will be next Tuesday, June 13th at 2 o'clock Eastern Time, and we'll provide an update on the new Congress administration and what lies ahead. On behalf of the Council of State Governments, thank you for joining us, and please contact us if you have any questions or topic suggestions. Thanks again to our panel, and we hope you will join us next time. Thanks.
Thank you.